How is it possible that people making hundreds of millions or even billions of dollars a year are paying a lower tax rate than you? Teachers, nurses, hardworking people like you are the backbone of this country. Yet, somehow, the ultra rich have found a way to sidestep their taxes and have left you with the bill. So, how do they do it? The answer lies in how the IRS treats different types of income and how the ultra rich take advantage of that fact. But here's the thing, we can learn from them. In this video, I'm going to explain strategies that the ultra rich use to squirrel their way out of contributing to society and how you can use that knowledge to keep more of your own money and build wealth. And I'll even explain how after you've built that wealth, you can use some clever management to pay 0% in capital gains tax. Let's dive in. See, most of us earn our money through good old-fashioned hard work. We show up, put in the hours, and collect a paycheck. That paycheck is taxed as ordinary income, which falls under the federal tax brackets that we all have to deal with every time we file our taxes. But the ultra-wealthy, their money doesn't come from a paycheck. It comes from investments like company stock, real estate, private equity. And profits from stock sales for assets you've held for over a year are taxed at a much lower long-term capital gains rate, which tops out at just 20%, compared to 37% for the highest ordinary income tax bracket. But here's the kicker. You only pay those taxes when you sell the investment. This is where billionaires have a huge advantage, because if they don't sell, they don't pay. Their wealth skyrockets year after year, but since those unrealized gains aren't considered taxable income by the IRS, they owe nothing. This is why we need to look at a different metric, their true tax rate, which measures the taxes paid relative to how much their net worth actually increases. Take Elon Musk, for example. When he bribes the president by helping to get him elected and his net worth goes up by $170 billion, if he only triggers a small taxable event, his true tax rate could end up being as low as 1 to 3%. Meanwhile, Ms. Higgins over here is getting a quarter of her paycheck snatched away every month. Someone who is making tens of billions of dollars every year can legally pay zero taxes as long as they don't sell. And can we just stop for a second? Most people don't actually comprehend how much $1 billion is. Imagine a magic genie appears and he hands you $1,000, tax-free of course, every single day. To get to $1 million, it would take you 2 years and 9 months. That's not bad. But to get to $1 billion at the same pace, it wouldn't take 10 years, not 100 years, not even 1,000 years. It would take you 2,740 years, over 2.5 millennia just to get to 1 billion. And there are people out there who have 10x, 100x that amount of money. It's literally impossible for them to run out of money because it grows faster than they can physically spend it. Like, what are we even doing? Sorry, where was I? Oh yeah, billionaires have infinite money that they don't pay taxes on unless they sell. So you're thinking, okay, well, if all their wealth is tied up in stock, sooner or later they'll have to sell to pay for whatever it is that billionaires are buying, and eventually they'll have to pay those taxes. And you'd be right, except for the fact that you forgot that our tax law is written by and for the ultra rich. See, instead of selling those assets and triggering a massive tax bill, they use this clever little trick. They borrow against them in what we could call the buy, borrow, die method. Let's break it down. The first step is to buy assets that appreciate over time, like stocks, real estate, or businesses. These assets grow in value without generating a lot of taxable income. Now, instead of selling those assets, they borrow against them by using their assets as collateral to get loans at super low, often single-digit interest rates. This allows them to access cash without having to sell their investments and pay those capital gains taxes, which, as mentioned, is an already lower tax rate compared to ordinary income tax. They can use this money to fund their lavish lifestyles, buy more assets, or even to donate to political campaigns out of the goodness of their heart, with no other intention or ulterior motive but to improve society for everyone. So now you're thinking, okay, hold up. That sort of makes sense, but eventually they'll have to pay off those loans, And surely they'll have to sell their investments and finally pay those taxes, right? Except you're wrong again, because, and pay attention, they keep borrowing and living their best life until they eventually just die. And when they do, their heirs inherit those appreciated assets. But, and this is the best part, their heirs receive those assets on what's known as a stepped up basis. This means that assets are revalued at their current market price, not at the price originally paid. So, all those unrealized capital gains that the billionaire never paid taxes on, poof, gone, vanished into thin air, just like the Epstein footage. The heirs get a clean slate and can continue the cycle, further increasing the wealth gap and avoiding taxes all along the way. The debt that was owed from our billionaire friend is settled with the estate, but using assets that are sold at this stepped up cost basis, so no capital gains taxes ever paid. How cool is that? So, while Elon Musk makes more money in a single day than you'll make in 100 years, you're the one who has to carry the load for all those corporate tax breaks. Now, if this seems unfair, it's because it totally is. But if you don't want to get left behind, you need to start taking advantage of this system. If you can't beat them, join them. And what that means is you need to be building your investments until your net worth primarily grows through your investments, not from your salary. Now, of course, you need a salary to build your investments, and the higher the better. But with ordinary income, you've got this huge headwind of income taxes. Just consider, you're giving up 20 to 30% of everything you make every single year, which is really limiting your ability to grow wealth, so you need a more efficient way. Your salary is just a means to an end, and that end is to build investments that can fully take over generating your income. So what I want to do is just take a little bit of time to show you how valuable and how powerful investments can be over time. And so what we've got here is we've got this investment calculator that allows us to basically simulate what our investments can do given a variety of inputs. And so hypothetically, in this scenario, let's say you're just starting your career, you're young, you've got nothing though, you've got no money, great. But we've got a lot of time, right? Time is on our side, and we've got, let's say, 40 years until we retire. Let's say you put all that money, just dump it into an index fund, S&P 500. Average rate of return for the S&P 500 is going to be about 8%, so let's put that. And let's say you're contributing $300 every single month, right? We hit calculate, we'll see what we get. With this given scenario, starting with 0, 40 years of time, and contributing $300 consistently every month, you will end up with almost $1 million, which is crazy to think about if you consider that you really only contributed $144,000, right? $800,000 of that is coming from growth just from your investments. And you can see how that looks here, right? You can see just how over time, the amount that your net worth explodes due to interest is so much higher than what you contribute, all because of the time and the compounding that investments do over time. And so again, if we look more at the accumulation schedule here, with $300 a month, you're contributing $3,600 a year, right? And the interest on that starts off pretty small, right? It's only $154 compared to your $3,600 every month. But every year after that, you can see basically your growth in your investments ends up contributing a little bit more and a little bit more until eventually, right about here in year 10, your investments are actually contributing to your net worth growth more than what you're contributing every year, right? Your investments are now starting to outpace what you are putting in from your contributions. And as we continue to go down, year 20, your investment growth is almost 4 times what you're contributing out of your salary. And this just continues to explode over time. And here down at the end, you're getting almost $72,000 just in investment growth, right? Without you having to even do anything. While you're still here putting $3,000 in from your salary, your investments without doing anything is $72,000. And again, these are all those basically tax-free growth. You'll be a little bit of taxes from like dividends and if you sell stuff, whatever. But this is basically happening, all this accumulation every single month is basically all tax-free, right? And so something like this, this is really great to play around with. You can put in different starting amounts based on where you are. You can put on, how much, change the time that you have, change your contribution amount. And the great thing is about this is we only assumed that you're putting a $300 this entire time, where in reality, as your career continues to grow, as you progress through that career, you're going to be making more and more money. You can continue to bump up this contribution, and so you can easily end up with over $1, over $2, over $3 million in retirement. Again, if you give yourself enough time and you start early. But the key here, folks, is that you got to start investing. And again, you don't need to be putting in thousands of dollars. Even just a couple hundred, we've shown, couple hundred, even $50 will have a huge impact on your ability to grow wealth. I'll post a link to this investment calculator in the description below, and I highly suggest playing around with it to see what could be possible for you given your financial situation. But the bottom line is, by focusing on your investments, you can develop a mechanism that increases your wealth in a much more tax-efficient way. And you can even supercharge these efforts by using tax-efficient retirement accounts like a 401k, 403b, TSP, or IRA. Then, eventually, you'll reach retirement and you'll finally need to spend that money. And this is where you can use a really clever method to significantly avoid some hefty taxes. Let's break this down. As it turns out, the IRS has a 0% capital gains tax if your taxable income is under a certain amount. Now, if we think of this tax threshold as a bucket, you'll have different sources of income to fill that bucket. Social Security, required minimum distributions, RMDs, from your traditional IRA, or any other type of standard income you may have will all count as taxable income, and these will take up space in your bucket first. If you need more money, you can withdraw from your traditional IRA or 401k, but here's the trick. Don't take out too much or you'll push yourself into a higher tax bracket, which can make those capital gains taxable. As long as you leave some space in your bucket and stay under the threshold, you can sell your stocks with long-term capital gains and pay zero tax on those profits. After that, if you still need more cash, you can pull from your Roth IRA or 401k to avoid getting bumped above the threshold. Because remember, withdrawals from a Roth account are completely tax-free and don't count towards taxable income. Ultimately, by strategically managing your withdrawals across these various types of accounts, you could technically have an income that is higher than the IRS threshold and still have the benefit of paying 0% in capital gains, just like the billionaires. This was a simplified explanation of this concept, so I'll post a video going over this in more detail, and I'll link it here when it's available. Knowledge is power, and you too can learn how to use the techniques of the ultra-rich to start building your net worth in the most tax-efficient way possible. If you want to learn more about building wealth and not falling behind, be sure to subscribe to my channel, and I'll see you in the next video. Venture on.